Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures just a little negative on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Same movie, different title.
We've had these head fakes.
The pivot trade.
This moderation in the Fed talk.
These bear market rallies.
We've seen them before this year.
We've been here before.
We just did that back in June.
Be careful not to declare premature victory on some of these rallies.
We don't want to get too comfortable.
A pivoting Fed is a bull case for equities.
It's hard to think that the pivot is anywhere on the horizon.
The Fed just started raising rates this March.
It's way too early to say capitulation. I mean, I think that's heroic.
The fundamental issue is that this is a market that has extraordinary impatience.
We're looking for messaging or any potential that they're going to pause.
Investors seemingly have no tolerance for pain.
As it's been the entire year, hope springs eternal.
Let's get to it. I'm pleased to say joining us this morning is Mohammed Al-Arian of Bloomberg Opinion and, of course, of Queen's College, Cambridge. Mohammed, always a privilege, a pleasure to catch up with you, sir. We've had the pivot, we've had the pause, and now we're talking about a step down. Is it just more wishful thinking, Mohammed?
First, good morning, John. Look, you're dealing with a market that for over a decade has been conditioned by central banks to look for liquidity catalyst. So that catalyst has gone from being a cut in interest rates to being a pause on rates, to being a slowing in rates. The only reason that would be justified as a catalyst is if you believe valuations are low enough, and if you believe we're not going to get derailed either by an economic or a financial accident. I think of it as a trading opportunity, but I don't think of it as the basis for a sustainable rally, not as yet.
You wrote about financial accidents, financial instability, earlier this week. You said inflation requires faster increases, which intensify the threat of large financial accidents that can have nasty economic spillovers. It is time to recognize that the speed with which interest rates are going higher for longer significantly increases the risk of financial stability. So, Mohammed, the ECB had to come up with TPI, the transmission protection instrument, whatever that is. The BOGs had to intervene in the FX market. The Bank of England's had to buy gilts, that gilt market operation of the last month or so. Who's next? How are you thinking about this?
So there will be next. What's common in all of these is that the source of disruption was the sovereign side, was something that these central banks could access directly. The issue for the US, the issue for Japan is the cross holdings are things that the central bank cannot access directly with its balance sheet. And also, it is very difficult for the world's most important central bank to distinguish between monetary policy and financial stability, which other central banks can do more easily. So it gets complicated, John. This trilemma of lowering inflation, minimizing the hit to jobs and growth, and containing financial instability, it's a really tricky one.
One thing you've talked about, you wrote about it in the last couple of months, is pushing the brake and the accelerator simultaneously. I think it was an interview back on radio in the UK, Mohammed, where you mentioned that concept. Is that what you're expecting to see from the Fed? Because they're doing QT, they're raising interest rates. And one question I've asked, Mohammed, is how much longer they'll be able to do QT for, given what we're seeing materialize in the world and global markets?
John, the major problem is not QT. The major problem is this is one of the most front-loaded interest rate hiking cycles for a very long time. And we will get another 75 basis points next week. Will be 4 straight 75 basis points. And you're doing that within a system that has optimized low for very long and QE forever. So you have a system that optimized this. The Fed has no choice but to front load its hike because it's so behind and core inflation continues to go up. And it is how do you realign, if you like, the financial system to the new realities of these massive front-loaded hikes. It is not easy. That is one of the costs of being behind for the Fed. And the only concern here, John, is whether financial volatility undermines the real economy. That is what they should be looking at, and that is what they should be assessing, particularly when it comes to the non-banks.
Do you think it does?
I think it can. I'm hoping it won't, but I think it can. You know, it's a global economy that is slowing. We know that. That's not a great context to be doing front-loaded interest rate hikes. We have, and you've talked about it, many people who think a U.S. recession is a done deal. Bloomberg Economics says 100%. I'm not there, but a lot of people believe we're going there. And we have a market that I think has priced in interest rate risk, has priced in somewhat credit risk, and is hoping not to have to price in liquidity risk. So that is the configuration you have, and it's a very tricky one right now, John.
You just said I'm not there. Why are you not there yet?
Because I believe the U.S. labor market is still strong, and I believe that the Fed can hopefully still find a way around this. Am I comfortable? No. I've shared with you my feeling that the risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck, because it no longer has time.
You said the labour market was still strong. Do you think you can get inflation on a trajectory where they're confident, convinced it's heading back towards target over the medium term, Mohammed, without inflicting damage on this labour market?
A lot will depend on the wage determination issue. And you've asked a key question. And if you're wondering about what's going to happen to inflation, don't look at whether the price of gas is going up and down. Don't look at all the other things that we were looking at before. Look at how the labor market is functioning. Look at wage determination, because that's going to be the answer to whether we get even more stubborn inflation. The alternative being you only bring it down with a recession, which is not something that we want to see.
You've talked about the risk of a flip-flopping Fed, the 1970s. I remember that column from earlier this summer. Bill Dudley wrote a column for Bloomberg earlier this week, Mohammed, and he talked about whether this Fed was the Volcker Fed or the Fed of Burns, the latter not being much of a compliment, if you believe this is what Chairman Powell is right now. Any similarities to Burns or Volcker at this point, Mohammed? You've read that piece. How did you react to it?
It's a good piece. You know, Bill produces really good, thoughtful pieces that should be read. Look, it's clear what Chair Powell wants. He wants to be associated with Volcker. He wants the credibility, to borrow the credibility of Volcker. And he has cited Volcker in virtually every public statement since Jackson Hole. So it's very clear how he wants to be seen, and for good reason. If you can borrow that credibility, you don't need to be as aggressive on rates. The problem that he has that Volcker did not have is a trilemma. Volcker dealt with growth and inflation. Chair Powell has on top of that financial stability. If they pivot, it will be because of financial stability. It's not going to be because they've decided to not look at inflation anymore. It will be because of financial stability. And the risk here is that we get a quagmire of stagflation as we try and lower the financial stability risk. Again, John, that is what happens when you're late. You have fewer degrees of freedom.
Two pieces there. Let's pick out the first one, and then I'll get to the stagflation story. Do you think there's a difference between what Chairman Powell wants to signal and what he actually wants to do?
I hope not, because credibility is critical in this process. So I hope not. I hope that he's signaling what he wants to do and that he will remain on that path. Otherwise, forward policy guidance gets really undermined.
I remember there was something you said, and this picks up on the point you made up at the end there on stagflation. You said earlier this year that we might have to get to a point where we just tolerate higher inflation. We basically have a choice. It's either recession or tolerate higher inflation. Are you leaning in one direction more than the other at the moment, Mohammed?
You know, this is like the old lives versus livelihoods discussion when we had COVID in the beginning. And the answer to that is not to pose the question that way, but to have both lives and livelihoods. Look, that discussion, if you remember, had more to do with longer term. Will central banks and will society accept a higher inflation target to allow all these structural changes to take place within the economy? And the reality is that if you were designing the inflation target today, you would not come up with 2%. You'd come up with something higher. the reality also is that changing what you have now is really difficult, especially when inflation is a problem. So we're not going to see a change in inflation target. We will probably end up tolerating exposed to higher inflation than we would have otherwise. The key issue, John, I keep on stressing this, and I was really happy at the annual meetings of the IMF and the World Bank to see this has become a topic. Financial stability. Just don't underestimate that how you can break something in the financial system, and you've got to keep an eye on the non-banks.
Mohammed, if financial stability or financial instability causes a pause of this Federal Reserve hiking cycle, is that bullish or not?
Some may see it as bullish. I wouldn't say it's bullish because if this happens, it's because we got very close or had a financial accident. And if that happens, then you have another shock to growth. You have another shock to corporate earnings. And then you would need liquidity somehow to overcome so many walls of worry that I'm not sure liquidity can do it anymore. You know, liquidity helped us a lot when we didn't have inflation, when growth was okay. It wasn't great, but it was okay. When corporations were achieving efficiency gains. We're not in that world, John. We're in a very different world. You know, don't forget there's also supply chains that are being changed. This is a very different world.
Mohammed, this would have sounded very depressing, except I spoke to Nouriel Roubini about 15 minutes ago, and that set the bar really, really low for this conversation, and I'm walking away from this relatively happy. Mohammed, you're wonderful. Thanks for being with us as always. Mohammed Al-Arian of Queen's College, Cambridge, on the latest in this economy and this market too. And for the Federal Reserve, futures right now down about 1/10% on the S&P. Tons of earnings through this morning. On top of that story is Kelly Lyons. Hey, Kaylee.
Yeah, it's a big day and a big week, John. About $5.3 trillion worth of market cap is reporting. And altogether with the reports of this morning, we have now seen about a quarter of the S&P 500 reporting. And so far, not so bad. Actually, when you add in this morning's reports, we are to profit growth on average on a year-on-year basis of about 0.9%. 58% of companies topping their results from a year ago. You're also seeing growth on sales of about 10% and upside surprises on both metrics. About 71% of companies reported thus far have topped expectations when it comes to profits. As for some of the companies that have done so this morning, GM is one, handily surpassing estimates with a record revenue and affirmed full-year forecast. So it's up about 3.3%. You have Coca-Cola and UPS up about 2.5% each after beats of their own. Coca-Cola is really about revenue growth driven by higher prices. One outlier on the negative side, though, is 3M, which again cut its forecast for the second time this year due to a strong dollar and economic uncertainty. So it's down about 3.5%. And of course, that's not all. We have more reports coming after the bell today, including giants like Alphabet and Microsoft. And those companies, along with their peers, are expecting to see a material slowdown from the sky-high revenue growth we saw just a year ago. Meta, for example, expected to actually see sales declines of about 6%. For Apple, Alphabet and Microsoft, we're expecting single-digit revenue growth. Just to put that in context, that would be the first time we haven't seen double digits on that figure from Microsoft in 21 quarters. And that's just on the top line. On the bottom line, profits for Apple, Microsoft, Alphabet, and Amazon and Meta are expected to fall by the most in at least 3 years. And remember, those names together make up about 16% of the S&P 500, John.
Kelly, unreal. Thank you, as always. Kelly Lyons there. The team after the close, at the close, will break down those numbers for you from Alphabet and Microsoft. Coming up, geopolitical concerns, raising the stakes for Democrats ahead of the midterms.
I have not seen this letter. I will say this, that we're certainly very thankful of the bipartisan support that we have seen over the past several months during this war from Congress, and we're going to continue to keep those lines of communications open.
We'll talk about that letter next.
The geopolitics going in Russia, Ukraine, America, China, the relationships of the Western world, and that would have me far more concerned than whether it's a mild or slightly severe recession.
Geopolitics front and centre for Jamie Dimon as a group of Democrats urges President Biden to shift his strategy on Ukraine, writing in a letter, quote, "We urge you to pair the military and economic support the United States has provided to Ukraine with a proactive diplomatic push, redoubling efforts to seek a realistic framework for a ceasefire, including direct engagement with Russia." Progressives quickly walking back the letter, but not before raising questions of cracks within the party. Bloomberg's Anne-Marie joined us now from the White House for more. AMH, walk us through this one, please.
So this letter comes out, Jonathan, and the White House swiftly says that there will be no talks with Russia if Ukraine is not represented. And also you had Admiral John Kirby, the National Security Council spokesperson, saying Mr. Putin is clearly in no mood to negotiate. So then you have these progressives walking back some of these comments and wanting to clarify that this is not them putting pressure on the Biden administration to change tact, but just wanting to offer a diplomatic solution alongside what is happening, which is a ton of money being sent to Ukraine and the fact that they don't want this protracted war. But clearly, Jonathan, what you are seeing is that there could potentially be some cracks within the Democratic Party. You and I just yesterday spoke about what Kevin McCarthy, the House Republican leader, talking about that there's not going to be a blank check anymore for Ukraine potentially in the new Congress. So I think what's clear is that the strategy for Ukraine during 2022 may change for 2023 after the midterms, as you see a ton of pressure on these lawmakers on the economics of what's going on in the United States. We should note that for the Kremlin, this is something they will have laser eyes on, not just cracks within the United States, but really the NATO alliance writ large.
Ahead of a key vote, AMH, thank you. Down in Washington, 2 weeks away from the midterms. What do the midterms mean to this market, if anything at all? This from Wei Li and the team over at BlackRock. Equities usually do well after US midterms. Why? Gridlock is common and prevents policy change that could spook stocks. They went on to say, we don't see that past playbook working this time due to the recession we expect from the Fed ratcheting up rates. Joining us now is Julie Beale of Kane Anderson Rudnick, Richard Bernstein of RB Advisors. Julie, first to you. Does that line from BlackRock resonate with you?
Yeah, I think that the understanding the underlying risks that we have is more important than, the previous historical data. For sure, we can understand why gridlock is positive from a regulatory standpoint, but I think at the end of the day, the fundamentals of slowing consumer and higher interest rates is going to be more important than anything else.
Richard, let's talk about the fundamentals. I have a lot of people who tell me now that we've priced in the bulk of this rate hiking cycle with a peak in the Fed funds of about 5%. I have a lot of people also telling me we haven't really fully discounted the consequences of that hiking cycle. Richard, how would you respond to that?
Jonathan, I would say not only is there the questions about whether the hiking cycle is over, which I think is a bit premature to start talking about pivots and things like that with inflation, headline inflation at 8.2%, I think is very premature. But the other side of that is that there's been very little discussion about earnings and how we are really heading towards a profits recession in the first half of 2023. We haven't yet seen analysts just completely capitulate on their earnings forecast. You still have this notion that a lot of stocks are going to be immune to the economy, even though the stock prices are down. You haven't seen the capitulation yet on that.
It's something Mike Wilson has said over at Morgan Stanley as well. Julie, are you seeing any signs of that earnings weakness start to emerge? Because what I hear from the equity bears is that that's a story now for 2023. You're going to push that story out to early next year.
Well, I mean, so far, earnings have actually been pretty robust. I've been impressed by the level of strength and underlying, opportunities for companies. Guidance hasn't been great. And I think it's important to factor in that, we talk about currency as being, well, I'm going to look at these numbers, the, X currency, right? Because I want to understand the underlying growth rate. But at the end of the day, free cash flow is still in US dollars. And so inflation has an impact as well as currency. So I think it's important to bear in mind that FX is not just this overlay that we put on things. It actually has a meaningful impact on what the profitability and finances are going to be for these companies. And I think that has definitely not been priced in.
Julie, you've talked about the weakness of the consumer. We've just had house price data, home price growth in the US slowing the most on record. We've got a bid back into the bond market. Yields are lower by 11 basis points on a 10-year, on a 2-year by about 5 basis points. Julie, as I say, and I'll repeat myself, you've warned repeatedly about the weakness that you think is going to emerge in this consumer. Are you seeing that right now off the back of what is happening with things like home price growth?
Yeah, if you think about the US consumer, so much of their wealth is actually tied up into their homes. And so for the moment, you're seeing quite a bit of stickiness in terms of people being willing to price down their homes because they're not really being forced into doing that. Many people refinanced, during the last 3 or 4 years. And so they don't really want to step out of their house, if they're paying 3 or 4% interest to step into 6, 7, 8% interest. So I think that creates a lot of stickiness in the housing prices. But once they have to start coming in, once you start getting those comps of people who have to sell, people start to feel a lot less wealthy. And I think that starts to impact demand and behavior.
Julie, you do something that I do that I'm not sure many people in our audience do, which is you go on Rightmove in the UK and look at house prices. I do that every single day, and I'm happy to share that with you. Julie, what do you learn when you go on Rightmove in the UK to look at house prices?
Well, the UK market is really different, and I think people underestimate that. Is half of homes in the UK are owned outright, and so I think that lends a little bit more stability to their market. But you also have 2/3 of homes that are forced, so that could be overwhelming debt, divorce, or death. Those are the 3 Ds. And so that creates a certain underlying stability in terms of the transactions that are going to get processed. So I think Rightmove's actually really well positioned in that business. But yes, I love spending time on Rightmove. It's a delight.
Likewise, it's an addiction, maybe an unhealthy one. Richard, final question to you, sir. Looking at this bond market and the way it's responding to bad news, do you think this bond market starts to respond to bad news in the way that we would expect it to? Can you buy bonds going into this downturn?
So, Jonathan, I think, if the Fed does continue to raise rates, the natural reaction, what history suggests, is that the curve will invert not only by the Fed raising short-term rates, but by the long end of the curve starting to rally. In other words, sensing future slowdown, sensing a future recession. And so I think if, one has a 6 to 12-month time frame, then certainly the long end of the curve is starting to get attractive. If you're worried about the next 6 to 12 weeks, maybe not. Because I think, as the Fed raises rates, if inflation stays higher for longer than people think, clearly, and especially in the likelihood of QT, the 10-year is not going to perform very well in the next 6 to 12 weeks.
Richard Bernstein, Julie Bill, to the two of you, thank you. That housing data, not pretty. We're down 11 basis points on a 10-year to 413 on a 2-year. To about 446, lower by 4 basis points. Up next, the morning calls, and later, 4,300 on the S&P in the next 6 months. That's the call from Stifel's Barry Bannister. 4 minutes away from the opening bout, just about turning positive on the S&P 500. The house price data out of the United States, not pretty at all. Bond yields roll over just a little bit more on a 10-year. Yields lower by a little more than 10 basis points. Your 10-year right now at 4.12%. That's the price action. Here's some morning calls. First up, Piper Sandler upgrading Planet Fitness to overweight, expecting a jump in memberships following recent channel checks. Your second call from Wow's upgrading Ross stores to overweight, highlighting the retailer's improving fundamentals and shrinking inventories. And finally, KeyBank cutting price targets on Alphabet and Meta ahead of earnings, growing skeptical of future revenue growth amid mounting recession fears. That stock positive by 0.6%. Your earnings wrap up next. 24 seconds away from the opening bout this Tuesday morning. Good morning to you. Over the previous 2 days on the S&P 500, up around about 3.6%. Friday and Monday, really strong days of gains on the S&P. Futures just about unchanged, just about turning positive off the back of some really dreadful house price data in America. Switch on the board and have a look at the bond market off the back of that. Another leg lower on 10-year yields, down by 14 basis points now on a 10-year, 4.0979%. Off the back of that move on yields, I can tell you some dollar weakness kicks in and some euro strength. Euro dollar reclaiming a 99 handle, 99.27, up 0.5% on that currency pair, and crude reclaims 85 on WTI, $85 a barrel, up around about 0.5%. In the equity market then, around the opening bout, what are we, about 20 seconds into this on the S&P? We're positive by just 0.1%. A little bit later, though, all about the earnings. Big tech headlining a monster week. Microsoft, Alphabet, Amazon, Apple, Meta, all on deck. Dan Ives of Wedbush calling it the moment of truth for the tech sector. I think Dan said that about 10 different times over the last couple of years. But anyway, we're entering a crucial 3Q earnings season that'll either expose negative underlying fundamentals across tech, cause massive earnings cuts into 23 and further multiple compression, or prove that the bearishness and demise of growth tech was premature. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. It's really a make or break week, especially for the 5 biggest tech stocks by revenue. If you take that quintet, which starts with Alphabet and Microsoft this Tuesday, but also includes Apple, Amazon and Meta, EPS is forecast to decline 22% year on year, the biggest drop in EPS since 3 years. And this mega cap group of 5 faces its 3rd consecutive quarter of shrinking profits. Even so, look at the green on the screen. Traders have kind of turned defensive in recent sessions, driving up these stocks. I think on the NASDAQ 100, we're up for a 3rd consecutive day, the best streak of gains since for about a month's period of time. But each company has its own story, right? The overview is shrinking profits across all 5, 22% drop on EPS year on year for that 5. Thinking about Google, we still expect top-line growth for the Alphabet of 12%, more than the average of the S&P 500. But after the ad shock from Snap, we are asking questions about the resiliency of search and the questions about YouTube. And any sort of wavering in commentary could change projections, which are for the story around Alphabet to improve over the next year. Microsoft, really interesting, if you come into my Bloomberg terminal, projected to have its first single-digit sales growth, non-double-digit sales growth, going back 21 quarters. I think that gives a real sense of how the picture's changed. In terms of your earnings calendar, John, this is what the week looks like. We start with Alphabet and Microsoft this Tuesday, but it's a brutal week, and it all comes to a crescendo on Thursday, where you have Amazon and Apple, the kind of key names, but look at the others sprinkled throughout. Intel also going to be massively important, given the commentary, I suppose, we're seeing out of the chip sector.
Just about come to terms with calling Google Alphabet. I still can't call Facebook Meta.
I know, I apologise.
Meta, I'm just not there yet, Ed. One of the best, Ed. Looking forward to your coverage, buddy, a little bit later after the close. Ed Ludlow there on the West Coast. Sticking with tech, MKM's Rohit Kulkarni. Lowering estimates on Amazon, Google and Meta ahead of results, cutting price targets despite keeping a more optimistic outlook in the longer run. Rohit Kulkarni joins us right now. Rohit, fantastic to catch up with you, sir. It's been too long. Let's just start with the cut to Amazon, if we can. It seems to me in your note that this was focused more on the e-commerce side of the business. Walk us through what you're seeing.
Hey, thanks for having me. And again, defensive is the name of the week this week. On Amazon, I think it's just about uncertainty and limited visibility. The way we are talking to a lot of e-commerce sellers, Prime Day that happened in October, whether that pulled forward some of the demand away from November into October. So I think for e-commerce, the concern here is do we have visibility into what the consumer is going to do during November and parts of December? I doubt Amazon would be saying that consumer is healthy and we see a lot of good traction in e-commerce. So I think that's where we are cutting numbers. I think Amazon would err on the side of being more conservative when they give guidance. I think they have already had one too many misses in the last 3-4 quarters. So I think they would be conservative. They would say, we don't know what's going to happen in November or December. So we are going to have a wider range of guidance. So might as well be prudent about that. Street would interpret that as, this is not great good news, so probably let's take the foot off the pedal. So that's where we think near term there is no visibility into what's going to happen, and that's why a lot of stocks are going to stay range bound in the near term.
Rohit, we've had what I would call a capacity demand mismatch over the last couple of years. They had tons of demand, race to build out capacity, they build out capacity, and then the demand starts to weaken. Rohit, have we worked that out yet, or is that something that's going to take a whole lot longer from here?
We are probably in the, using a sports metaphor here, we are probably in the 4th or 5th inning of, we are midway or probably ahead of the midway point. So this Q4, we are going to see that capacity getting utilized. But again, come 1Q, they have already built those fulfillment centers. They're going to be empty in 1Q. So there is a point of time until probably mid of next year, which is when Amazon would have grown into the demand that they would have otherwise needed to have that capacity utilization to the optimal level. So there is still probably under 3 months, maybe 6 months before we actually see Amazon start to inflect on profitability on the e-commerce side. But yes, they also have the largest cloud company there, which also churns out a lot of cash. So there is going to be a whole lot of focus on how much are they going to maintain the profitability on the cloud platform right now.
We're also looking right here to what's happening with ad spend at various companies, looking ahead to Meta, to Alphabet on that front as well. On Snap, you said Snap had difficulty remaining under control of its own destiny. Your quote, do you think the likes of Meta has control of its own destiny?
they're not as out of control as Snap. Again, Snap is a very small and tiny company. They don't, what they say is probably a small part of the entire mosaic of ad spend. Yes, ad spend is slowing down. Ad spend is definitely going to be slower in 4Q, but it's not falling off the cliff. It is at a point where it is getting turned on and turned off in a way that can hurt smaller companies a lot quickly than larger companies that tend to be almost like the tax on internet. So Google is the tax on internet. Facebook to some extent is a tax on internet. So the first dollar spent always goes to these two companies, and the waterfall tends to kind of dry out as you go to smaller companies like Snap and others down the waterfall. The only thing that I would say is if Snap was weak, brand spend is weak, so probably YouTube is going to be weak. Maybe Twitter is going to be weak. So that's how we tie the loose ends here. Not so much for search or not so much for Facebook as such.
Can we finish on Twitter? I imagine not a company you'll be following for much longer from here, given the fact it's likely to go private in the not too distant future. Twitter reports, the reports around Twitter that they're cutting 75% of the staff if Elon Musk comes on board when that gets finalized and that deal closes. Rohit, as you look at the company, have the best already left? Are they waiting to watch what happens here?
Again, I would characterize 75% cut for any company to be highly egregious in nature. I think there is partially some of it is signaling, some of it is Musk trying to save severance dollars by kind of accelerating the voluntary churn, if you will, is my interpretation. But when it comes to retaining talent and it's very costly here in Silicon Valley. So I think that's going to be challenging for Twitter. There are still a lot of private companies that are doing a lot of innovative work, and Twitter, under the next probably call it 6 to 12 months under Musk umbrella, is going to have a lot of volatility. So yeah, that is going to add to probably some market share loss from Twitter to smaller companies like Snap and Pinterest.
Rohit, wonderful to catch up with you, sir. Don't be a stranger. Rohit Kulkarni there on the latest. Snap, Meta, Twitter in early trading positive. Equities right now just about positive on the S&P 500 by 0.2%. The Nasdaq up 0.6%. Yields are a whole lot lower. Twos out to 30s. On a 10-year, we're down 14 basis points. On a 2-year, we're down 8. Keep going back to this house price data out of the UK. Home price data out of the United States, rather. Really not good at all. Stifel's Barry Bannister is looking for this S&P to rise 13% in the next 6 months. Peak Fed hawkishness is in the price. Expect inflation to cool, delaying recession into mid-23 and lifting the S&P 500 to 4,300 in the next 6 months. Barry joins us right now. Barry was excited for this, the road to 4,300, so let's get to it. You say we've discounted the rate hiking cycle. Let's talk about the economic weakness. How do you manage that? You just push it out to 23 and ignore it until when?
No, the economy is slowing, and you want that. You want inflation to slow as well, and so does the Fed. The question is, as Sam Zell once said, every day you don't sell, you buy. And every day that the Fed doesn't turn the volume dial of tightening to the right, they're actually easing. And I don't expect incremental tightening, certainly not beyond what's already in Fed funds futures. It's not necessary. If I can break down with Thomas Carroll the inflation into energy, food, goods, durable and non-durable, as well as shelter and non-energy, non-utility services, and then find leading indicators, all of which point down for inflation, then the Fed can do the same. And they know inflation is going to come down. So the slowing economy, former Chair Yellen's comments at Treasury the other day about bond market concerns at the Treasury, all of this gives cover to the Fed, I think, to move towards not tightening further, and in fact, in the first half of 23, possibly taking 1 or 2 of those rate hikes close to 5% out of futures. It isn't necessary. We're going to get lower inflation and lower growth, but it's not a classical recession.
So Barry, talk to me about how you ultimately play this through the equity market. Let's take a data point this morning. House price growth comes in weaker, softer, negative, worse than expected. Bonds rally, yields lower by 14 basis points. In that kind of world, what do I want to own in the equity market? The cyclicals or the big tech names? Which one is it?
Well, as you know, the stock market's just a trade-off between two questions: economic growth, which drives earnings, and inflation, which drives your multiple. So price earnings times your earnings. That's your price. If you look at where we see inflation going, it's lower. So disinflation from a very high inflation environment. And if you look at economic growth, we do think it's weak. But again, a recession is income, production, employment, investment, and sales. I don't see that kind of universal weakness that you would classify as an NBER recession. So if I think the economy is slightly better and inflation is weaker, it pushes you back into growth stocks, and that would be big tech. So we'll see how the earnings are this week. You also want some cyclicals, though. I think the economy, it's oversold, and typically October to the following April, they're pretty good trades. It's a bad thing to fight that, just like it's a bad thing to fight the Fed. And so I like early cycle cyclicals. These would be banks, even housing for the intrepid, and semiconductor short cycle cyclicals. So I would go with cyclical, and I would go with a combination of growth and value.
Barry, when you say the economy's oversold, let's build that out just a little bit more. I'm looking at high yield spreads at about 500 basis points. Historically, sort of slap bang on the average kind of spread you'd expect, and certainly not the kind of spread you'd expect in a recession. Can you learn anything from credit here whatsoever, Barry?
Well, I look at high yield and IG, and the spreads are up, but they're certainly not worse than they were in the last decade. You think about 2011, 12, 2015, 16, 2018. We had some pretty big spikes there in yields and spreads. But if I look at the leading indicators for that, I don't see the kind of weakness in the default rate implied in those spreads that would justify a hair on fire panic moment here. I think the market is going to see a slowdown. It's already discounted a slowdown. And the question is it going to get substantially worse and cascade into a recession? I don't think that's going to happen before middle to third quarter of 23. And that depends on what the Fed does really in the next 6 months.
So, Barry, of course, it comes to the price of the story. And I think the Fed game and the game around economic weakness feel like two different games. Barry, when you say to me we've priced in the bulk of the hiking cycle with a peak of Fed funds at 5%, I think most people would agree with you. When it comes to the consequences of that, the economic weakness associated with it, if you look at asset classes right now and ask yourself, how far are we on the road towards adjusting to a weaker world of economic growth? Some people push back against that, Barry, and point to credit spreads and just say, we haven't done the hard work yet. What do you say back to them?
Well, back to the spreads. I mean, the corporates have termed out a lot of their debt. We don't have the crash in energy and raw materials that drove, for example, that huge spike about 6 years ago in high yield. So I am pretty optimistic that we won't have that kind of a blowout of spreads. They also are fairly cash rich, although the cash is not evenly distributed among the corporates. One thing I would say, though, is that when I look at the Fed funds futures, for example, Bloomberg FFJ3, the May futures, it's 5%, okay? It's just under 5%. That's about 0.5% more than the Fed probably needs to do, and we'll get some clarity on whether that's going to happen in the first quarter of 2023. If they start to backpedal a little bit, and I thought, again, Yellen's comments the other day were very important political cover, really, for the Fed. She rarely says anything that's not thought out in advance. Very smart lady. For example, she endorsed a second term for Jay Powell publicly in late 21 when it was being waffled on by the White House. So when she made that comment about bonds, I thought that was very important for the Fed because they can use that as part of their holistic cover to throttle back if the economy slows and inflation slows, as I expect.
Hey, Barry, we've got to leave it there. Can I just say, don't wait too long to come back on. It's been too long. Barry Bannister there at Stifel. Barry, thank you. Need to look at Chinese tech as well. The Nasdaq Golden Dragon China Index, 65 Chinese stocks in that index, got absolutely battered yesterday. Baba, JD, Baidu all tanked at one point yesterday, close to 20%. Baba today, Alibaba, up by about 1%. I can tell you where the weakness continues. It's in China's currency. Coming up, that currency extending its declines to a third day.
From a trade perspective, you could argue that dollar CNY could potentially go north of 750 quite quickly. Quite quickly, I think, is what the Chinese want to stop.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Jose Munoz, Hyundai Motor American president and CEO. That conversation at 11:30 a.m. Eastern, 4:30 p.m. in London. This is Bloomberg.
From a trade perspective, you could argue that dollar CNY could potentially go north of 750 quite quickly. Quite quickly, I think, is what the Chinese want to stop. When you look at capital flows, yes, we've had capital outflows in terms of bond markets and equities, but it has been relatively orderly.
China's yuan plunging to multi-year lows, signalling the PBOC is loosening its grip on the currency and stoking fresh volatility in equities. JP Morgan's Marko Kolanovic seeing an entry point amid the sell-off, writing something that sounds a whole lot like what he wrote back in June. We believe this is a good opportunity to add, given an expected growth recovery, gradual COVID reopening and monetary and fiscal stimulus. A trade for the brave, perhaps, at this point. Your team coverage starts right now with Bloomberg's Katie Lyons and Damian Sassak. Katie, yesterday, for those stocks listed here in the United States, brutal.
It was absolute carnage. It was awful, not just here in the United States, but in Asia as well. The Hang Seng China Enterprises Index had its worst day since 2008. You saw a little bit of a rebound in the overnight session, though, and when it comes to those ETFs, you are seeing a rebound as well, though it only goes so far to unwind some of the damage seen yesterday. The iShares MSCI China ETF, for example, up about 2.3%, and the Crane Shares CSI China ETF up 4.8% after having a record day of losses yesterday. Now, you pointed out Marko Kolanovic saying that now is the time to come buy in, and that he also said something pretty similar since June. So just a word of warning on what has happened since he initially made that call about 4 months ago. We saw a lot of inflows into the MCHI ETF, the largest China ETF, in June, record inflows, in fact. And since then, we're down another 35% from there. So that may be why dip buyers aren't all avid this morning coming in to buy those stocks while they are cheaper. There has to be a calculus between risk and reward here as they question whether or not Xi Jinping in his third term is going to have even more market unfriendly policies. And that concern mostly is showing up domestically in Chinese equities. It's less so in companies that have high revenue exposure to China. An index of those stocks only down about 21%, I say only, over the last year, but that compares to a 49% loss for the MSCI China Index, John.
That's the equity story. Let's talk about foreign exchange. Today in the bond market, monster rally off the back of some weaker data a little bit earlier this hour. House price data in the United States, much more softer, negative than expected. We're down 16 basis points on a 10-year right now. On a Treasury, yields just about 4.1%, just south of that level. On a 2-year, 440, down 10 basis points. In G10, dollar a whole lot weaker against the Chinese currency. Damian Sasser, anything but. That really stands out on a morning like this morning, doesn't it?
Yeah, absolutely. Well, and look, if you're talking about the offshore yuan, that's at the weakest level we've ever seen since it was launched in 2010. If you're looking at the onshore yuan, weakest in over a decade. And the reason that I'm really focused on, it's the basis, it's the differential between the two, because we saw that blow out to something on the order of 570 pips earlier this morning, John. 570 pips, that's 2.5 standard deviations. I mean, that's a huge, huge move. It's bigger than the move we saw in the 2020 VAR shock. So obviously there's a little bit of bloodletting going on here. And what I'm saying is the offshore yuan is leading the way. It's showing that much more weakness over the onshore. What's interesting is if you look at 1 month, 25 delta risk reversals, which is kind of an indication of the demand for protection against continued yuan weakness, we're at a 1.7 standard deviation move. So, clearly, the pain is out there and people are feeling it.
Clearly, the concern is off the back of the events over the weekend, with President Xi doubling down, tightening his grip on power in the country. Is the PBOC going to tolerate this, Damian, given what you're seeing materialize?
Well, I mean, look, the new candidate, Ying Yang, for the PBOC governorship is basically someone who is really not an insider, but, he's certainly a loyalist. I think the real thing is Premier. I mean, we got Shanghai's, former, the one who oversaw the lockdowns in Shanghai. So clearly we're not seeing any pivot away from COVID zero, Jonathan. That's the big story here. That's what markets were hoping for, that you'd see some sort of a shift away from that. You're not getting it, and that's what's leaning on the equity market. This is going to be the first year, by the way, since Stock Connect was formed, Jonathan, where equity outflows, net equity outflows for the full year 2022 out of China. I mean, that's a pretty telling story, I think.
Hey, Damian, thank you. Damian Sasser, Katie Lyons. Allow me to run through the price action of this morning so far. About 23 minutes into this. On the S&P, we're up again for a third straight session, up by 0.8%. Big run of gains here on the Nasdaq, up by 1.5%, off the back of a monster rally in the bond market. How many times have we seen moves like this? big move to the bond market. Yields down by 16 basis points. Call it 17 basis points lower on a 10-year, down 10 on a 2-year. The data weak in America and the dollar index rolling over. The dollar index negative 0.9%. Up next on this program, your trading diary. I thought Tuesday would be boring. Right now, anything but. About 26 minutes into the session, the dollar's weaker, the bond market's absolutely ripping. Yields are much lower, and equities are up as well. Yields down right now on a 10-year by 16 basis points. That's the price action. Here's your trading diary. President Biden speaking at 2 p.m. Eastern, followed by earnings from Alphabet and Microsoft after the closing bell. Meta and Twitter reporting on Wednesday. Then it's Amazon and Apple on Thursday. Plus, a busy day of data with jobless claims, US GDP, and an ECB rate decision. And we close out the week with a BOJ rate decision coming up on Friday. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.